Thank you so much, Kishore. My name is Rajiv Thakkar, and welcome to all the participants for the CFA Society event. I work with PPFS Asset Management as a Chief Investment Officer for the mutual fund operations. And it is my pleasure today to introduce Larry Swedroe, Chief Research Officer at Buckingham Wealth Partners. Larry is a prolific writer. It will be amazing for people to know that he's authored 8 books on his own, and he's authored 9 books as a co-author. The last of those that being in April of 2022. The last book has been on sustainable investing, and we'll take the opportunity to get his thoughts on that subject as well in the Q&A session. But I'm sure the audience will benefit from Larry's deep insight and research, and he's a proponent of evidence-based investing. Rather than just propounding theory, he goes into the data behind the theory. And as he was mentioning to me before the session started, that if the data does not agree with the theory, it is the theory that has to go out and not the data. So without taking much of your time, let me hand over the floor to Larry, and we'll go through his presentation, and then I'll come back for the Q&A.
Thank you so very much, and great to be with you all. Today's talk is all about the value of patience and how the all too human behavioral mistakes of recency bias, relativism, and engaging in what we call resulting leads so many investors to abandon even well thought out plans. As I'm sure you're all well aware, over the last decade or so, US stocks have far outperformed international stocks and emerging market stocks, and growth stocks have far outperformed value stocks. And that has led many to question the benefits of diversifying their portfolios and ask the question, what do you do when a strategy performs poorly? Today's talk is an attempt, my attempt to answer those questions. So to begin, if we could put that first slide up, at Buckingham Strategic Wealth, our investment strategy is based upon the 3 core principles. If we could go to the next slide. The 3 core principles are, one is that markets are highly efficient, though not perfectly so. There are limits to arbitrage, as I'm sure you're well aware of, that prevent sophisticated investors from fully arbitraging prices or correcting mispricing. But in effect, the markets are highly efficient, making active management a loser's game. And that doesn't mean the people playing it are losers. It's just like Las Vegas or buying lottery tickets, where it's possible to win the game, but the odds of doing so are so poor, the prudent strategy is not to try. And that leads us to use what people refer to as passive strategies or indexing. We don't like either term. In fact, we rarely use index funds except a total market fund because there are negatives of indexing that can be minimized or eliminated by sophisticated strategies. So we use the term systematic, replicable, and transparent. So that's our first premise there. Markets are highly efficient, so we use systematic strategies. Now, if you believe that markets are highly efficient, the only rational thing that should follow from that is that all risk assets must have similar risk-adjusted returns. Now, we could use Sharpe ratio as a measure of risk, but we also know Sharpe ratios are not fully incorporating what people think of in risk. Doesn't look at skewness, kurtosis, those fat tails, which people hate the left side of. And it doesn't account for liquidity risk either, which should also carry a premium. But that's a way to think about it. Now, if you believe that markets are efficient and then all risk assets should have similar risk-adjusted returns, which you should, because if asset A has higher risk-adjusted returns than B, let's say US stocks are A emerging market stocks are B, then capital flees B, driving valuations down and expected returns up, and valuations of A up and expected returns down till we get an equilibrium. Now, if you believe that all risk assets should have similar risk-adjusted returns, once we account for not only volatility, but tail risk and liquidity, then the only logical conclusion I believe you can reach, and this is what we practice at Buckingham, is that portfolios should be, I use the term hyper-diversified, meaning they're broadly diversified across as many unique or independent sources of risk that meet the criteria that Andy Birkin and I established in our complete guide to factor-based investing. We'll talk more about that at the end of the talk. The problem for most investors is that traditional portfolios are dominated by a single risk. Let's go to that next slide. So unfortunately, most investors, and I have found even financial advisors, if you ask them if you have a 60-40 portfolio, how much of your portfolio is invested in stocks from the risk perspective, they'll say 60%, but sophisticated investors using metrics like banks use value at risk know much better. And the reason is that the riskiness of stocks is much greater than the riskiness of the safe traditional bonds. In the US, we would use US Treasuries or FDIC insured CDs or very high grade municipal bonds in there. So if we think about it from a value at risk perspective, we could think about it roughly, and the well-diversified equity portfolio has about a volatility of 20. That would give you about 1,200 risk points. A volatility of a safe intermediate treasury bond portfolio might have a volatility of 5. So we get 200 risk points. We get 1,400 total. And that means that 1,200 or 86% of the risk is in the equity portion. And the problem is, of course, that that doesn't align with this concept we've just walked through, that if you believe all risk assets have similar risk-adjusted returns, you should diversify the portfolio. Now, however, once you begin to diversify a portfolio, adding unique risks, you create this psychological problem, a dreaded disease for many investors known as tracking variance regret, or some use the term tracking error regret. And that leads to the mistake of we call resulting, which is judging the performance or the quality of a decision based on the outcome rather than the quality of the process that went into making that decision. If we go to the next slide. So this is one of my favorite quotes. I'll let you read it for a second here. But over my 25 years as an investment advisor, I've learned that one of the greatest problems preventing investors from staying the course and achieving their goals is that when it comes to risk assets, they think they can judge performance by looking at 3 years. That's a long time. 5 years is a very long time, and 10 years is an eternity. Even supposedly more sophisticated investors like institutions who hire high-paid consultants tend to fire and hire managers based on the last 3 years' performance. And that tendency causes them to make the critical mistake of assuming that good outcomes are the result of good process and bad outcomes are a result of bad process. Now, we know better than that when it comes to many things in life. For example, we buy life insurance, we don't die, we don't look back and say, boy, that was a dumb decision buying that life insurance. In sports, unfortunately, I'll use an American analogy, we do make this resulting mistake. It's what's called Monday morning quarterbacking, second guessing the decisions based upon the outcome. when that's really the wrong way to think about it, because we cannot predict the future well. So we know as sophisticated investors that while most people consider 10 years to be a long time to evaluate performance, and I think they view it almost like an eternity, we know much better, and we know that 10 years can really be nothing more than noise, a random outcome. And there's no better evidence of this. If we could go to the next slide, we have 3 periods of at least 13 years. This shocks most investors, where US Treasury bills, 1-month bills, outperform the S&P 500, even though the S&P 500 has outperformed over the last 94 years or so by 7% compound a year. Almost half of that period of 45 total years, it underperformed T-bills, which of course means the rest of the period, it far outperformed. But the fact that we have these long periods, I hope doesn't mean that people give up on the idea that stocks should outperform bonds. The economic logic, is simple. They're riskier and investors demand the risk premium. But it must be the case that that risk can show up. Otherwise, for long-term investors, and there shouldn't be any other kind, there really is no risk. Now, these kinds of periods hopefully doesn't cause investors to abandon their plans. And I don't think, lots of people don't, but some do. And that causes them to buy high after periods of strong performance and sell low after periods of bad performance. And buying high and selling low is not a good strategy. But I think more people are accepting of these long periods of underperformance when it comes to broad indices like the S&P 500. If you begin to become more of an unconventional investor, then you become less tolerant. And we know that all risky assets are going to experience long periods of underperformance. That's true of international stocks, emerging market stocks, real estate. I mean, gold, which is thought of as an inflation hedge, from 1980s peak of about 850 to 2002, it was under 300, and inflation averaged 4% a year. That means gold lost 86% about of its real value. So that's another example that all risk assets must be able to experience these very long periods of underperformance. And that's why we want to diversify. That key principle, that third principle I mentioned, because we don't have a clear crystal ball. We don't know which of these asset classes will diversify. So having long periods of underperformance is not a reason to avoid an asset class. It's a reason to diversify. And a knowledge of history, as all of you here today, our CFA should have. If we go to the next slide, we can show the benefits of diversification. This slide takes the historical evidence back to 1927, except for profitability and quality. Newer factors, we don't have data going back that far, goes back to 64 in profitability and 58 for quality. And it looks at their historical premiums and their standard deviation, then runs Monte Carlos to see what are the odds we think of a negative expected premium. As you look at this chart, you should observe 3 things. But let me first clarify here what P1, 2, and 3 are. So P1 takes this principle that we might call of as risk parity or broad diversification. It just uses a 1/n naive approach. So we're going to create a portfolio that is long, short, beta, size, value, momentum, the first 4, and equal weight them. P2 adds another factor, profitability, and weights them equally 20%. And then P3 substitutes the broader quality measure. Profitability is one of the quality metrics. And now, hopefully, as I've been explaining this, you should have been able to observe 3 key things in this slide. The first is that the longer the period is, the lower the odds of getting a negative return, showing you the importance of discipline and staying patient. Second thing is that no matter how long the period, there's always risk of negative performance. At 20 years, the estimates on a Monte Carlo show us about a 3% chance of getting a negative premium over that horizon. The fact that momentum showed zero there, we all know that it's never zero, but that's just the outcome. So we have to treat it that way. And the third thing, and I think the most important part of this is, if you look at it, each of the more diversified portfolios has much lower odds of getting a negative premium than any of the individual ones. So the bottom line is that diversification can reduce the risk of investing in risky assets. It cannot eliminate them, which brings us to the question of how do you judge the quality of a decision in building your portfolios. If we go to the next slide. This slide just shows that allocations there here. So here we go. Yeah, we could move on to the quote now. So Nassim Nicholas Taleb, I'm sure most of you are well familiar with. I thought he had a great explanation about why investors should avoid this mistake I call confusing strategy with outcome. He said, one cannot judge a performance in any given field by the results, but by the cost of the alternative. That is, if history had played out in a different way, such substitute course of events are called alternative histories. Clearly, the quality of a decision cannot be solely judged based on its outcome, but such a point seems to be voiced only by people who fail. Those who succeed attribute their success to the quality of their decision. So the problem is that we have this all too human bias known as hindsight bias, which is the tendency after an outcome is known to see it as virtually inevitable, contributes to this mistake of resulting. John Stepek, author of a book called The Skeptical Investor, advised it this way. He said, you must accept that you can neither know the future nor control it. Thus, the key to successful investing is to make good decisions in the face of uncertainty based on a strong understanding of your goals and a strong understanding of the tools available to you to help you achieve those goals. We know a single decision that's made well can lead to a bad outcome, but the making of many good decisions over time should compound into a better outcome than making a series of bad ones. Making good decisions is mostly about putting distance between your gut and your investment choice. So the bottom line is that we live in a world of uncertainty where the best we can do is estimate the odds of outcome. And a strategy should be judged on the quality of the process that went into it, not after the outcome is known. The period since the great financial crisis provides a test of investors' ability to avoid the mistake of confusing strategy with outcome. Again, we call that resulting. Next slide. So if you see here on this slide, over the last 14 years, the S&P 500 was the best performing asset class. US stocks had very similar returns among these four major asset classes, but growth clearly outperformed value and large outperformed small. But the real massive dispersion in outcomes came from the international and emerging markets, which dramatically outperformed, putting investors to a test. Could they stay disciplined? And as we know here, the period from 2017 through 2020 was the biggest drawdown in value history, about 50%. Now, unfortunately, those kind of results from international stocks, emerging stocks, and value stocks caused many investors to abandon even a well thought out strategy of diversifying. But should you judge the strategy to have been a poor one based on the outcome, not if you look at it through the lens provided by Taylor? So to help you think about the right way to think about it, let's look, our next slide, we'll look at how an investor viewed the world coming into that period. And he doesn't have that perfect foresight. Well, we saw the exact reverse. Here we had wide dispersions of outcomes in the US, with small outperforming by a lot and small value outperforming massively over an 8-year period. This was the biggest value premium in history. And international stocks outperformed the US, and emerging markets was the star of all stars. So going into this period, most people say, wow, we've got to have diversified portfolios. Maybe we want to overweight value and growth. And then, of course, they got the other impact. But how did the world look? Let's go back to the period just before this. Before we go there, this slide demonstrates that tracking variance works both ways. Sometimes you get outperformance, sometimes you get underperformance, but you shouldn't care because you believe diversification is the right strategy because of the principles we put through. All right, so now let's go to the next slide where the world looked very different entering that period where emerging markets and value and small far outperformed. Let's say you're an investor in 1994 and you have read the literature and you understand economics. You decide, I'm going to build a highly diversified portfolio across factors, adding small and value tilts, and I'm going to load up as well on emerging markets, international, at least get me a market cap weighting. And the next 5 years, you get these results look at least similar to what happened in the last 5 years. And now 5 years go by and you say, oh my goodness, I got it wrong. I'm going to throw out the theory of diversification, ignore the historical long-term evidence, and now I'm going to sell my small and value and emerging markets and international, load up on the S&P. And of course, the next 8 years you got slaughtered, had big underperformance. So now maybe you wake up and say, you know, I had it right the first time. I just lost patience. And now I'm going to switch back. And then the next 13 years you underperform again. That's the problem of recency bias, the problem of engaging in resulting, causing investors to persistently buy high and sell low, not a good strategy. So it's what happens is we have these twin problems I've mentioned, recency, but we also have the problems of relativity or relativism, which we can define as how the performance of your portfolio does against a major index reported by the media and talked about in social media all of the time. And that causes, those two together cause people to abandon their well thought out plans. Let's go to the next slide. So John Bogle called this a period of age of investment relativism, where investor satisfaction is judged not on how their portfolio is doing in achieving their goals, but in how it's doing against some benchmark, which should be irrelevant to them if you accept the wisdom of diversification. I think relativism is the triumph of emotion over wisdom and experience, because we know that today's trends are nothing more than noise in the big picture. I think Bogle put it best. He was sort of quoting Einstein. He said, relativity did work well for Einstein, but it has no place in investing. And we all know the problems of recency bias causing people to chase performance. And the evidence shows that because of that, investors tend to, on average, underperform the very performance of the investments they own because of that. Now, we can observe how pernicious this buy high, sell low strategy can be by examining current valuations. So let's take a quick look on it on our next slide. And here we're going to see the current Cape 10s are as they were at the end of last year. And no surprise here, the Cape 10, which is as good an estimate as we have if we invert it to get an earnings yield of the future expected real returns. Those big outperformance of US stocks lead to a much lower expected return. But investors chasing performance are now selling the developed markets and emerging market stocks, which have much higher expected returns. Now we can measure the relative valuations of international stocks also by looking at current earnings, which as it turns out, if we look at our next slide, have just as good of predictive power, roughly about 40% of the future expected returns. And this is where we stood at the end of last year. So you could see investors who are subject to relativism and recency bias and engaging in resulting, they end up buying at high valuations when expected returns are low, and they end up selling at low valuations when expected returns are high. All right, we have another problem to discuss, which is impatience, and this results, I think, from a knowledge of financial history. Let's go to the next slide. So Warren Buffett believed that when it comes to investing, temperament trumps intelligence all the time, and he tells people to ignore the noise of the markets, and he says if you can't resist trying to time the market, then you want to buy when everyone else is panic selling and there's blood on the streets, and you want to sell when everyone else is getting greedy. And you could see here, look at this 10-year period, first 10 years of the decade, we had T-bills outperforming the S&P 500 by almost 4% a year, a cumulative underperformance of 40%. A great example of the fact that all risky assets can underperform. But the next slide is even more powerful. This one may shock even some of you here who are knowledgeable investors. Here we have a 40-year period. Now imagine you're a pension plan with nominal obligations. For you, the safe investment is long-term treasuries, and you have a 40-year period here where US Treasury longer-term 20-year bonds outperform growth stocks of all kinds and outperform small growth stocks by 4% a year. That's 40 years of underperformance. Why do people abandon value strategies when they underperform for 3 or 4 years? Why do people abandon emerging markets when they underperform for a decade? But I would hope no one abandoned the idea that growth stocks should underperform treasury, or growth stocks should outperform treasuries just because we have this 40-year period. Investors in risky assets such as stocks, and more specifically small in value and emerging markets, have to understand that they are virtually certain to experience long periods of underperformance, which leads us to the strategy of diversifying, not concentrating, because we don't know which asset class will be the one or the next one to go through that period. Just imagine Japanese investors in 1990 who, biased by recency, home country bias, just loaded up on Japanese stocks. And we don't know, maybe the next 30 years we'll see the US have that Japanese experience. We don't know. That's why we want to diversify. So before we close, I want to move on to, if 10 years isn't enough, how do you know what is the way to judge whether a strategy is the right one? When do you know it's no longer working? So if we go to the next slide, that shows the criteria that Andy Birkin and I created in our book, Your Complete Guide to Factor-Based Investing. I'm really proud of this because we now see this quoted all the time, even in academic papers. We think in order to make sure you're minimizing the risks of data mining outcomes here, and that there really is a valid strategy here, The strategy has to show evidence of a premium that has been persistent over very long periods of time and across economic regimes. It has to be pervasive across countries, geographies, sectors, and even asset classes. That helps give us more confidence. Value, for example, works in stocks, bonds, commodities, and currencies. Momentum does as well. It has to be robust to various definitions. So, for example, we know value works whether you use price to book, cash flow, sales, earnings, it doesn't matter. And in fact, the evidence in finance, as well as many other fields, is you're much better off using an ensemble metric than any one individual metric. You're getting some benefits of diversification there. It's also important that the strategy be survivable after excuse me, after transactions costs. Doesn't do any good if small caps or micro caps give you a 5% premium, let's say, but they cost 8% to trade. And lastly, you have to have reasons that are intuitive why you should believe the premium should persist. Now, we prefer a risk-based premium. Why? Because risk cannot be arbitraged away, although cash flows coming in can reduce that premium, of course. But we're willing to accept behavioral explanations for two reasons. One, there are, as I mentioned earlier, these limits to arbitrage and the cost and risk of shorting. But we also know that human behavior tends not to change very much. So let's, and by the way, there's one other point I need to mention, that valuations do matter. Although it's extremely difficult to try to time factors, and we don't recommend doing that. We recommend just rebalancing portfolios. But valuations matter, and if you, even a good strategy, if you get bubbles and drive valuations to extreme levels, then of course you can have problems. So we get what can be called crowded trades, and we want to see if the strategies we're using have gotten crowded, possibly because, for example, of publication of research. What we have heard from many people is value is done poorly because everyone knows about it and the trades have gotten crowded. So let's take a look, and the next slide will show you how, if value has in fact got crowded. And what I did here is I showed back right after Fama and French published their paper, the relative price to book ratios of US large growth to large value was about 2 to 1. The end of last year was roughly double. That shows that it's really nonsensical to believe that the trade got crowded. If that was the case, the spread would narrow to eliminate the premium. So that makes no sense. Let's look at the next slide, and we see the same thing when we look at price to earnings ratios. The spread had widened, and we can see the same results on the next slide. Here, when we look at smaller stocks, small growth versus small value, again, the spread has widened, and we can see it again if we look at earnings ratios on the next slide. Again, you can see here almost had doubled. Having observed now that all risky assets go through long periods of poor performance and that relative valuations can change because of regime changes. Here, people should have been saying, if I believe in a value premium, I should be loading up on it if I wanted to make a bet. At the very least, you want to rebalance and buy more because you're getting value at the cheapest valuations relative based in history. Even with the last 18 months or so of value outperformance, we're still in about the 90th percentile or higher around the globe for value being relatively cheap. So now we want to answer the question again, how do we develop that core principles? And again, we're going to return here, a prudent strategy. Our next slide will show again what we talked about earlier, that the underlying premises should be these three key things. Markets are efficient, therefore don't try to be an active investor trying to time them, be a stock selector. Instead, build broadly diversified portfolios across the factors or asset classes you decide you have enough confidence in that you can stay the course. And then the second principle, again, is all risk assets should have similar risk-adjusted returns, which should lead you to this idea of building a hyper-diversified portfolio where you have all of the criteria met for each of your investments. So while diversification has been called the only free lunch in investing, as we showed in that one other slide, it doesn't eliminate the loss risk. It requires accepting the fact that parts of your portfolio are going to be doing poorly at any one time. In fact, some wise man once said to me that if some part of your portfolio isn't doing poorly at any point in time, then you're probably not diversified. And that means you have to accept the fact that there'll be some periods, some of them quite long, as we saw for the last 13 years, where a highly diversified portfolio is going to underperform some popular benchmark like the S&P 500. Diversification, as we saw, is hard. It's like celibacy for teenagers, someone said. And what makes it even harder is that we know is an all too human trait that misery loves company, meaning failing conventionally is easier. If you look like the market, you've got lots of other people who are miserable with you. If you fail unconventionally by having this diversified portfolio, and now you're more alone, and now it becomes harder. And the last thing I'll note is this. I have learned over my 25 years, observing poor performance, long periods of them in back tests is much easier to do than living through them in real time. And that's what makes it so difficult to be a successful investor and why good advisors can add value by educating people and keeping them disciplined. All of this is why Warren Buffett has said famously, investing is simple, but it's just not easy. Knowing your level of tolerance for this tracking variance regret can help you invest according to your principles. If you're able to accept tracking variance, you can get that only free lunch in investing, and you might as well eat as much of that buffet as you can if you can accept that tracking variance. On the other hand, if you're not able to do that or recognize that, then you should stick with the broader market portfolio, but that means accepting much greater tail risk. I think it was, the key here is there's no free lunch. You either have to accept concentration and tail risk, or you build diversified portfolios that allow you to reduce that potential dispersion of outcomes and give you a better chance of achieving your goals, especially those who are retirees who are subject to that dreaded sequence risk. At least between these two choices of concentration or accepting tracking variance, there is no free lunch. Michael Maupassant, I think one of the best financial economists, he had this to say on the subject. He said, a quality investment philosophy is like a good diet. It only works if it is sensible over the long haul and you stick with it. Agreeing with Warren Buffett, he observed, investment philosophy is really about temperament, not raw intelligence. So it's really important to get this balance, just as you do between stocks and bonds, this balance between diversification and your ability to accept tracking variance. Our last slide is a quote from Robin Rubin. And here's what Rubin had to say. Individual decisions can be badly thought through and yet be successful. For example, you could decide not to buy life insurance and you live to the ripe old age of 99. That was great, but that's not a good decision if you have young children and a family that if you died prematurely would be left in poverty. Or they can be exceedingly well thought through, but be unsuccessful because the recognized possibility of failure, in fact, does occur. But over time, he said, more thoughtful decision-making leads to better results, and more thoughtful decision-making can be encouraged by evaluating decisions on how well the process is done rather than the outcome. Hope you found this helpful. Thank you.
Thank you so much, Larry, for the wonderful presentation. It leads to a lot of questions. So I'll start with one primary one. At the beginning, you mentioned that what you do is you approach investing in a systematic and low-cost manner, not necessarily through index funds. So could you highlight a bit more about your approach and how do you go about it?
Yeah, so we know that there are some negatives of pure indexing. For example, I'm sure everyone here as a CFA is familiar with how bad an index the Russell 2000 is to replicate, because everybody knew what trades were needed to be done, and they could be exploited by active managers and then high frequency traders. And instead, you could have invested in something like the CRSP 10 or the MSCI 1750. Dimensional fund advisors created their own universe, say the bottom 5% of stocks. And then you create buy and hold ranges around them, so you don't have that forced immediate trading. And even then, you don't have to trade immediately. You can use algorithmic trading to sell very small lots and have market impact costs. The Russell 2000 underperformed the CRSP 610 by, I think, something like 2% a year. And in fact, Vanguard, which used to use that index, Gus Sauter, who ran the fund at the time, got them to abandon it. That's one simple example. You don't want to be exploited. You don't want to have forced trading. There was recently a good paper, even on the S&P 500, showing the impact of the trading cost, but it's not showing up in index performance because it's incorporating the trading costs in the index itself now. That's one thing. We also might prefer to have higher loadings on factors than an index might provide. There are many different value indices. Some of them have more exposure, for example, to a quality or profitability factor. That could be an issue. And indices generally don't incorporate, for example, momentum. All of the funds we use incorporate these ideas to minimize the risks of indexing or the negatives or eliminate them. And I'll add one other thing. We know that there's a whole slew of anomalies that exist because of limits to arbitrage. Standby, I think, identified 11 of them and built a model around that. And so, for example, the biggest one, I think, of all is that the performance of small cap growth stocks with high investment and low profitability, they've underperformed T-bills. Stocks in bankruptcy, 99% of them never pay a penny. Penny stocks underperform. IPOs generally underperform on average, right? And so if you're an indexer, you own all of these stocks. Well, an intelligent design could say, we're just going to screen those out. I'll give one other example comes to mind. We know the evidence shows that stocks with high shorting costs go on to underperform even after the high cost of shorting. So firms like the ones we use all incorporate screens that when a stock goes on special, even if it's in our buy range, we're going to suspend buying it. Now, they may not sell it because the trading costs could be swamped there, but they certainly don't need to buy it, but an index fund is going to continue to own it. So we don't use any index funds except for clients who want to have more of a market-like portfolio or even a small tilt. We would own something like a Vanguard Total Stock Market Fund or a Schwab fund, 3 basis points, and then add highly tilted portfolios with deep exposures to get us to the level we want. And that's the cheapest way and most tax efficient way to get to the level of factor exposure that you want.
Thanks a lot, Larry, for that. Larry, you mentioned that even time horizons as long as 10 years could be just noise and equity can underperform for an extended period of time. Whereas a lot of end investors, clients could have intermediate goals, let's say asset purchase down the road. Someone could have a 5-year goal or a 10-year goal. Uh, how does one go about making asset allocations?
Yeah.
Does the 60
So,
40 no longer work?
well, first of all, I'm a believer the 60-40 should be dead. Well, let's just touch on that for a moment because I think it's an important question. If you believe in the core principles that I showed you, then you should never have that 60-40 portfolio because it's not diversified. And we're seeing that really show up now. The reason the 60-40 has been so popular, if you will, because it's worked great for 40 years. And that was a fluke because if you go back to the early 80s, the PE ratios were at 5 or 6 because bond yields were in the teens. And what did we have over the next 40 years? We had a rising PE ratio, creating a tailwind for the equities. And we had collapsing inflation because of better monetary fiscal policies, at least until recently. And so we had tailwinds on bonds. And if you look at the 90 years or so or plus we have of data, a 60-40 portfolio earned about 8.5%. In the last, I think it was 30 years or so, it earned 10.5. You can't get there today when bond yields are now higher. They were even lower, but now let's say they're at 2.5 or something like that. So historically, they've averaged like 5, so that's not happening. And if you have US equity prices, even at current valuations, maybe you might expect a 5% real return. If you assume inflation, maybe 2.5, maybe that's 7.5. Well, if you got 7.5 for 60% and 2.5 for 40%, you're not getting 8.5%, right? And that's a problem there. So for a lot of people, that's an issue. Again, just the underlying economic theory should tell you, I think you should want a more diversified portfolio, ones that more look like those are the Harvards or the Yales who are trying to extract other premiums, including illiquidity, which is a free lunch for people who don't need it. In our case, we run a firm. I actually asked around and no one knew a single one of our clients who was taking more than their minimum required distribution. Now, of course, we deal with higher net worth people, but at age 90 even, there's a 10% RMD, that's all. That means you could, if you're not taking more than that, why not put 30, 40%, 50% in less liquid assets? They're still generating some income as well. And you could harvest big illiquidity premiums. We know once you turn a security and make it public, that same risk trades, let's call it 2 to 3% cheaper. So that's number one. The other point is this. People make the mistake of saying, Larry, I've got a 5-year horizon. I don't have the time to wait for smaller value or emerging markets. To me, that's about as dumb a statement as you could make. And the reason is simple. Over any long period of time, right, we should expect these asset classes in general to have pretty similar returns. Although today, as we saw, you should expect emerging markets and international stocks to outperform because they're cheap. But there's still, the expected returns are within 2 or 3 or 4%, right? In any one year, that gap could be 30, 40, 50%. So the shorter your horizon, the more important the principles of diversification becomes, because the dispersion in terms of returns is wider, not narrower, where what matters is how much you put in risk assets. So the longer your horizon, the more risk you could take, or I would say more economic cycle risk you can take. And that's where, so if you have a long horizon, you could take more economic cycle risk. If you have a short horizon, you want to make sure you're diversified, but you may want to keep a much higher percentage in safe assets that are not so subject to the economic cycle risk. that you won't have the cash available. So those are, I think, are the way to think about that problem.
Thanks, Larry. Larry, one small pushback on the cross-country comparisons, and I'm not trying to create an argument here, just to create some excitement and dive deeper. So when we look at, let's say, the US market versus emerging markets, the larger companies in the US are companies like Microsoft or Google and Apple. These are asset-light businesses and great return on equity and things like that. And when you compare it with some emerging market, it could be commodity-driven thing where current earning yield is looking high, but it's at a cyclical high, or the currency is something which weakens over time. So how relevant are these cross-country comparisons that we make?
Yeah, I think that's certainly an issue, and one way to address it is to make the comparison sector neutral. That's a way to address that problem. So you get that addressed, so you could adjust the numbers to do that. That's the way some investment firms do that as well. So, but keep in mind this, if you ask the average investor what's been the best performing asset class over the last 100 years, or sector, I want to say, I would virtually guarantee they would say healthcare and technology. Would you agree? That's a pretty good bet that that's what they would say. In fact, the two best performing asset classes have been alcohol and tobacco. Yeah. Just because something has high growth doesn't mean you get high returns. It's the price you pay for those assets. And the great growth companies of the 70s and 60s, they became the Nifty 50. Most of those companies, many of them aren't even around because disruptive technologies come along and knock them out. Many of those Nifty 50 are gone. Polaroid, Kodak, digital equipment, and I could go on. And who's to say that tomorrow the next Polaroids are not the Amazons or the Microsoft? Someone might. I'm not making any prediction, but that's a reason why you want to diversify, right? Because we don't know. The future is unknowable.
Sure, Larry. And towards the end, the very interesting work that you have done recently on sustainable investing and somewhat counterintuitive results that you got, if you can share those with the audience today.
Yeah, so when we sat down to write our book, Your Essential Guide to Sustainable Investing, we always begin with what's the economic theory behind this. And economic theory is pretty simple. If whole groups of investors screen out certain stocks, that doesn't change their earnings, it just changes their cost of capital, because you end up with higher debt costs and lower PE ratios. Well, if you get lower PE ratios, and so you're paying less for the same dollar of earnings, you get a higher return of capital. And the green stocks, the ones that people favor, have higher valuations and therefore lower expected returns. And right up till about 2017, the data completely confirmed that. The screened out sin stocks far outperformed, although it was interesting that much of that outperformance was explained by factor exposures. So to some degree, you can have your cake and eat it too if you screen out the bad brown stocks, but the remaining universe you now tilt to value, profitability, and investment factors, which are the characteristics of the sin stocks. They tend to be more profitable, cheaper, because people screen them out, and they're better at investments. So you can have your cake and eat it too. What happened was in 2017, a very similar event or timeline or turning point occurred as happened with indexing. So the first 20 years or so of John Bogle running Vanguard and has created the first index fund, we had a very slow trend towards indexing. When I started writing my first book in '98, I think a couple of % of US investors were indexing. And then the trend took off after the bubble burst. and then boom, and today we're at about 50%. We began, SRI was the original, now it's ESG Investing, has been around for hundreds of years. For example, Quakers would invest in companies that were engaged in the slave trade. You had apartheid screening against South Africa, those kinds of things. And people screened out guns, tobacco, alcohol, things like that. But really it began in 2005 when the principles of sustainable investing, ESG, was coined. We saw a beginning shift. And attention came to the thing. And we saw a beginning of a trend up. But in 2017, the Paris Accords and all the climate change issues, massive hurricanes and other stuff, brought this to the public's attention much more. And all of a sudden, we had tens of billions of dollars flowing every month into the green stocks. And you get this contrary or conflicting force going on. So ex ante, the brown stock should have a premium, let's call it 3%. But if you get enough cash flows driving green stock valuations up and maybe brown stock valuations down, in the short term, what do you get? Big capital gains and then lower expected returns once you reach equilibrium. And the reverse is true for brown. There was a very good paper, I think it was called The Shifting Equilibrium, which I wrote up in the book. And what they found is from 2017 through 20, even though brown stocks should have expected to outperform by 3% a year, they underperformed by 7% a year. So you had a 10% a year shift because of the purely caused by cash flows, nothing to do with differences in earnings. So you can get this short-term shift. And my own view is this, although I always say my crystal ball is cloudy, I think it's likely we're still in the early innings of this shift because in the US, we're only about a third towards ESG. And the surveys, if you ask people, and the younger generation is more interested, they're showing 80 to 90% will get there in 10 or 15 years. So I don't know when we reach an equilibrium. Maybe it stops at 50 or 70 or 80, we don't know. But I think we can say there's a reasonable chance that green stocks can actually at least continue to match the performance of brown, maybe even outperform. But as you get at some point, you reach that equilibrium, or even before that, that spread gets so wide that brown stocks should outperform. Now, I will add this. Importantly, two things. One is brown stocks have more risk. They have more risk of environmental disasters, lawsuits, consumer boycotts, fraud because of bad governance. So those premiums are not free lunches, right? They're compensation for risk. That's the most important thing that's related to that. And the second positive thing is investors in ESG strategies can really feel good. And then we have a whole chapter in the book on this because companies recognize that if they have a higher cost of capital, they're going to be uncompetitive. Their hurdle rates for investment will be higher. They won't have the money to spend. So they're changing their behaviors to make sure they treat their employees better. We're in the tightest labor market in history in the US. We normally have less than one job opening for every unemployed. And today we have almost two for every unemployed. If in a tight labor market, if you're not getting good ratings on social media, like Glassdoor, you can't attract people. So they're just getting these good scores on ESG. People want to work for companies who have good ESG scores, et cetera, is driving behavior leading to a better world for everybody. So you get this virtuous circle there. So that's a pretty important positive effect. So you can feel good, even if you end up with a bit lower returns, you help make the planet a better, safer place through achieving other goals. We don't do everything purely for monetary reasons.
Sure, Larry. So last question, something which is there on everybody's mind, and Vidhu Shekhar has asked this. Do you factor in inflation and interest rates in your asset allocation? So we are just coming out of a period where bond yields were negative on a real basis, equity valuations were elevated. How do you factor these things in?
Yeah, well, let's say it this way. Every quarter, we have a meeting of our investment policy committee, and we create capital market assumptions based upon current valuations and current yields. We make adjustments on interest rates based on long-term real returns and where yields are currently. So that's our way to adjust for that. We can't assume if you have, 4% inflation that you're going to have 2% bond yields or zero T-bills, right? But the second thing is really important. We don't worry much about inflation forecasts because equities and other assets, returns go up as inflations go up over the long term, of course, because they are real assets. So we don't worry too much about changing that. It gets built right in because if inflation is higher, we would expect equity returns to be higher, at least in nominal sense. And we try to, I will say it this way, we try to add assets that have inflation protection or minimization of risks into the portfolio. So for example, we invest in private floating rate debt through interval funds, all floating rate. Companies have a choice between 1 and 3 month LIBOR or SOFR. We invest in private consumer and small business lending that are 3 to 5 year loans, but fully amortizing, and people pay them off quickly because their yields are high. So the average maturity is only about a year. So that's an example. Reinsurance is another asset class, doesn't have inflation risk. If yields are going up, you're earning more on your collateral, right? And the values go up. And so, you have more, you collect your premium. So we look for assets like long-short portfolios that aren't subject to economic cycle risk or inflation risk. We want to include assets that have these unique risk factors and don't have exposure to either stocks or bonds, because investors have been reminded now of the lessons they were taught in the 50s, 60s, and 70s and early 80s. Fortunately, most investors today were not around then, but they should know their history. They think because of the last 40 years that stocks and bonds are negatively correlated, right? Because we've had these trends, and whenever the economy went south, the Fed would step in and tighten and print money and get the economy going. But bond yields, we never got the inflation spike. Well, in the 50s, 60s, and 70s and early 80s, we had both stocks and bonds going down. There were about 8 periods where that happened. And that's another reason why I think the 60-40 portfolio is dead, because people are being reminded of that. Doesn't mean you shouldn't own a significant amount of safe assets, but I think portfolios personally should be more like Ray Dalio's idea of risk parity. Maybe it's something closer to a third equities, a third safe bonds, and a third alternatives, depending upon your own unique ability, willingness, and need to take risk. My own portfolio now is close to 40% alternatives, about 30% equities, and about 30% safe bonds.
Thank you, Larry. There are plenty of more questions, but unfortunately, we have run out of time. Thank you for sharing your insights with us today.
My pleasure. Hopefully it was helpful.